Hey, all, welcome to ShareTreck. This is Sandeep here. We're here to talk about another wonderful fundamental analysis company. So let's get started. Welcome back, friendos. The company we're going to talk about today is a crowd favorite company and a company that is often seen as the exemplifier for what a growth stock is. And this company just had its best week in market history. It signed a huge deal. It reported a phenomenal earnings. And if you haven't guessed the company already, it is Netflix. Now, the deal we're talking about is actually it signed a deal with the WWE Wrestling to stream its flagship show, Raw, WWE Raw, in 2025 on Netflix, which could be huge revenue-wise, which I'll get into a little later. But I just want to get in a little background with me. I am a huge wrestling fan. I have a custom-made wrestling title with my name on it. And I've been watching since I was a wee little pup. In fact, just this past weekend, me and my good friendos, we saw the Royal Rumble, and it was quite the experience. Talking more so about the company, everyone. Netflix, first of all, it makes up about 2% of the NASDAQ 100, about 0.6% of the S&P 500. In a way, most of us, whether it's through direct shares or through an index fund or a mutual fund or even your pension fund, might have a wee bit of exposure to Netflix. And it's nice to know what's happening with a company which we are probably a little bit of owners of. As many of you might recall, in 2022, Netflix, which is a growth company and it's valuated as a growth company, not a value company or a dividend company, it came out with what I was telling my peers at the time. We were talking about stocks, was the worst earnings calls I had ever witnessed. Netflix, which was a growth company, had stopped growing. At that point in mid 2022, Netflix dropped to $162 a share. Wow. Since then, it has appreciated over 250% to trading at about $570 this past week, which is a massive increase. Any fund investor would be quite happy with those type of returns. We here, as fundamental investors, like to ask the question why and do a little bit of sleuthing, a little bit of detective work, and see where some of these changes are. And by finding that out, we can hopefully better understand and maybe even do a little prognosticating, a little Nostradamus work, and predict some of these signs in the future, find out some of these trends early, and that way, maybe we could generate some of these returns. It's nice to dream. It's nice to learn. Let's take a look. First of all, talking about a little bit of the stock price, looking particularly to their PE and their EV to EBITDA ratio. By the way, EV to EBITDA, I found out this past week from a professor that that is the metric that a lot of hedge funds look at, even often more so than DCF, to discounted cash flow. They love seeing this EV to EBITDA. And with the great portion that institutional investors make up, it's nice to know that. Bringing it back to what I was talking about, um, right now, the PE is trading 28% more than its historical average and 31% greater than historical average for EV to EBITDA. That is quite a difference. A lot of that is because the earnings came out and volatility, but what's going on? I took a look at the earnings, and what I'd like to tell you is I really like how Netflix does some of their earnings. When you go to their investor relations, they have all of their earnings with their management put up on YouTube for all of us to see under the YouTube name Netflix Investor Relations. Wish more companies did that. It's just so interactive, so nice, and so fast, and you could play at the speed you want. You could take a look at the like dislike ratio. It's cool. Wish more companies did that. Diving into the investor relations call, hearing from the management from their mouths. First of all, management says we had almost no price changes until late 2023, which is a partial quarter impact, and they continue to see member growth and growth thanks to the net additions of subscribers and ads, which is going to be a big term we're going to talk quite a bit about. No change in their pricing philosophy, and with more they see more members and more value created from those members, with occasional price changes here or there, and better than expected results from their price changes. What I think that Netflix is trying to say here is they are finding ways to get more value out of the members that they already have, whether that be from either being able to charge them more or being able to charge more from the advertising side for the same sort of subscribers. Referring to their ad tier, by the way, the company says there's room to bundle ad plans into lower pricing offers. So maybe in the next little while, you might say a little new tier of super ad plus or something. Who knows? If you do, we found it here in the earnings first. Their last earnings, I recall that the Netflix person said that 30% new signups from their ad tier alone. Quite a bit. They're putting price increases on hold for now because of the paid ad sharing, the price increase that came from the paid ad sharing stopping. What that means is a while ago, you might remember that the company took away our ability to share ads. Some people still find ways to work around that, but instead they put in a little way to get money out of that, which is proving to be almost like an ad increase in themselves, which is good for investors, maybe so different from the average person. Now they say that ads won't be a will be a won't pardon me will be a pricing driver in 2024 and build profitability. 13 million paid subscribers expected in as of Q4, which is what we just finished. They're seeing the biggest increase, however, in the Europe, Middle East, and Asia region, which is driving up revenues, and they're finding ways to launch additional products, probably more so experimenting and seeing with some of these ad tiers and subscriptions. Long-term capital revenue, they're saying, is very optimistic. $180 billion they're going to spend on the ad, minus China and Russia, 25 billion of that to connect to TV ads. Ad dollars following engagement, they say, is petitioned to capture well from their viewers. The biggest part they keep talking about from their earnings is the connected TV ads. And that is, in my opinion, bullish to ad companies. We talked about one a short while ago, which was The Trade Desk. Take a look at that video if you haven't already. Really, really impressive, intriguing company that you don't hear too often. Netflix does, however, use Microsoft for their ads, but Disney Plus does use Trade Desk. They mentioned some of their competitors. There isn't too much big about that beside from the constant theme of ads. The company did mention that they're holding right now about 10 to 15 billion dollars of gross debt, which is true and something to consider. But when we go into the balance sheet, that won't be too much of an issue. Speaking of, why don't we take a look at the balance sheet, and we'll see that a lot of the money coming in is from their ads. So what I've done here is I pulled this directly from the investor relations site of Netflix, and what I don't like about this company, I'm going to be very honest. I don't like this really ugly watermark they put in here. Like, geez, Netflix, please don't do this. This is embarrassingly ugly. So I went ahead and, of course, I made my own. I got a lot of this information from Bloomberg, by the way, but just looking at some of the important things, I'm not going to bore too much of you. We have $6.77 billion from operating cash. If we carry that over to the balance sheet and take a look at their actual cash, $1.13 billion in cash and cash equivalents in short-term investments. They do, however, have, and I've got highlighted right here, $8.86 billion in short-term liabilities and bills, which they have to take care of in the next 12 months. However, I'm not too worried about that because they have a significant $7.1 billion in cash. They also have a $1 billion credit line, which they haven't drawn upon and they haven't used at all. And they're bringing in over $1 billion every 3 months, every quarter from revenue, from income. So, in my opinion, I think the balance sheet risk is very low. It's not zero, but it's very low because the debt is manageable. What I also liked is this right here, basic and diluted EPS. Diluted is if they were to use all of their outstanding shares and do all the share offerings. There's very little difference, which makes me kind of happy that there's low risk of damage being done from the company dumping shares on us. And all of us out there in the genomics world are often too familiar with some of the companies using us as financing tools. I'm going to go ahead and just take a look at that Netflix and fun ratio over here. So many of the regular viewers know I like to talk about margin and I like seeing margin. And what I see over here is they see a massive margin increase, especially over here in net margin. By the way, the average S&P 500 company sees a net margin after everything of between 5 and 8%. Seeing some of these growth companies with crazy high margins in the 20s, very good. Their margin for Q4 is a little bit low, but I found that kind of often the case in some of the latter quarters, and I don't know why, but the company prices in the future and the future margin increasing, which is good. Better than companies like Walmart I was looking at a while ago, which has a negative net margin. But we want to see what's going on and why that is. So I am going to go over here and just click in add additions. By the way, that time when we were talking about ceased to become a growth company, that is roughly around here where they were losing subscribers every single quarter, which is not what Wall Street likes. Right over here, you see a great jump in subscribers, and Wall Street likes that. We like that, but what we like even more is the way they can extract much more from each and every person, each and every subscriber, which is Netflix is proving successful with. Now, what what I have discovered and what I've concluded from some of these is the big selling point of Netflix is it is proven to be a very smart company where it found a way to grow subscribers, but also get more money out of their subscribers. And the reason their method was ads. They're making greater margins off their ad tier subscribers. So this is good news. They're able to find out and to pick up on some of these trends and recover and go back to the growth company that they once were. That's really, really bullish. And I am going to be honest with all of you. I have not been too much of a Netflix bull. I was extraordinarily surprised, and I am so happy I found out where I was wrong because oftentimes we get stuck in this is a garbage stock, this is a great stock. We get stuck in our own biases. It's good to be aware of those biases and find out what's going on and how we could change. Now, a lot of folks, um, we remember our wonderful little PE price to earnings growth ratio sheet. Um, right now, Netflix is trading at $570. Their expected EPS, and I've looked at more than one source, is about 16.73, making their forward PE 34, about 34, which is actually very, very cheap. This is trading significantly cheaper than Costco, which is a favor of many. The company actually expects a huge EPS growth of nearly 40%, which will make their PEG ratio incredibly low, even by this out there wild, massive increase in stock price. But I went with some of the lower estimates because I like to be a little more conservative. Even then, 1.55 EPS, PEG, that is wow. I am not gonna lie, that is very, very intriguing and very, very I'm dumbfounded. I can't even believe that this company is valuated like that. I can't even believe the company is able to generate revenue like that and able to draw on this. I am a little bit excited because one, I'm a wrestling fan, and two, I didn't think of Netflix was be able to do this. So I am excited. I like seeing these numbers. I'm surprised by these numbers. These aren't NVIDIA numbers where NVIDIA is able to get 35% margins, but they are trading surprisingly cheaply, which is intriguing. I'm also going to talk a little bit more about what I'd like to do is talk a little bit more about the wrestling portion where Netflix signed a deal to stream WWE Raw, which is their flagship show in 2025. What I think is going to be a little bit of sleeper is I have been, like I said, a wrestling fan for years. I'm also a subscriber to the Wrestling Observer. So wrestling journalists like Dave Meltzer and Brian Alvarez of the Observer, they are very huge on this and they talk about numbers. WWE on their TV actually generates much more viewers than things like the NHL. But they have had an issue with advertisers where some companies would just not want to advertise on wrestling. That could change with Netflix. If WWE can bring in their huge amount of very loyal viewers into Netflix, that could be significant. That could be how they can get such a low PE despite the great appreciation. WWE, the network, they have this online subscription service which moved over to Peacock, and they're getting over 3.5, close to 4 million people watching that, which is paid each and every, well, right now on Peacock, which is a lot. It's much more than on their independent network. So, uh, in a way, I am bullish about their WWE subscription. I'm not saying that as a wrestling fan. I'm saying that as a numbers fan. In a way, it's WWE is almost considered a little undervalued in a way, considering how many viewers they bring in. Bringing Raw to Netflix and looking at their current ratios and looking at the way that Netflix can capitalize on ads. In conclusion, I am surprisingly bullish on what Netflix can do with ads, how they can generate more money with ads. So credit to Netflix. credit to anyone who was able to pick up on this and pick up on the revenue growth. If their numbers are correct, there is much more growth to be had. I am happy I was found wrong on this. Is Netflix a buy? Again, what we mentioned earlier, it's trading greater than the mean. We might see a pullback, we might not, but the company's financials surprisingly bullish. And um, I like to look at the price to earnings growth, but if people do want to learn or find out how to do something like a discounted cash flow, I did a DCF of AMD over here a while ago. If you do want to know that, let us know in the comments down below, and I'd be more than happy to share my Excel spreadsheets and teach everyone how to use some of these cool fundamental principles. But Netflix, pick great great company because of their ads. Little little hyped up right now. Consider pullback, but not financial advice. Do your own due diligence. Very bullish about this deal and very happy I've reviewed this company. But let me know, let us all ShareTreck people know down below. If you're a Netflix subscriber, and if you like the content over there, you're thinking about sticking with them. And also let me know what type of tier you're in. You're the ad tier, the regular tier, what else? Let us know. And are you happy with the service? Would you consider dropping to the ad tier service? And are you a subscriber or are you owner of the company? And do you like what's going on? And do you like what's up? Let me know if you want another if you want DCF, discounted cash flow. Let me know what company you'd like to review next. Thank you kindly, friendos, for giving me this opportunity. I am so grateful. I'm so happy to be here, and I'm so happy to be back next week with another fundamental analysis. Until then, have a good day, friendos, and stay based.